G'day and welcome to this week's video. My name is Rowan and I'm from Consorting Private Wealth. In today's video, we're going to be looking at what it takes to become a millionaire. Now, if you do want to be a millionaire, it may seem like the impossible dream for most, but depending on your circumstances, joining the Millionaires Club may be easier than you think. Now, it all comes down to these three key components, and it ultimately represents a successful saving strategy. Now, the first component is having surplus cash. So understanding, your budgeting and cash flow requirements and making sure that at the end of the day, once your expenses have been paid, that there's some left over. The second component is an investment return. So that needs to be meaningful. We probably look for growth assets to try and attain those larger returns. So that could be through property or the share market in the form of dividends. It's definitely, we may not get there as easily if we're holding all our money just simply in cash or in fixed interest deposits. And the final ingredient, and the most important one, is definitely time. So what might your path to millionaire status look like? Now, let's paint this picture or use this case study as an example. Let's say you're in your 20s and you've got the capacity to save for another 40 years. Now, we've run a projection via the government's Money Smart website and we've used the following criteria. Now, we've put a 10% investment return in, and based on that rate of return, the 20-year-old only needs to save $157 per month during that time frame. Now, that may sound like a lot, but if we break it down into a daily figure, it's a cup of barista-made coffee per day. Now, another way to look at this is your money that you're spending on your coffee per day is stopping you from becoming a millionaire. So if you turn it on its head, it's a fun way to look at things. Now, your total contribution over the 40 years, the money that you're putting yourself towards this investment is only approximately $75,000, and the other $925,000 comes from compounding investment returns. So the real mechanics behind this strategy is the returns that you're making from the compounding amount you initially invested. Now, if the time frame drops off a little bit, you don't have the 40 years, let's say you're in your late 30s or early 40s, for example. Let's say you've only got 20 years before you decide to retire. In that aspect, you'll need to save approximately $1,300 per month. Now, I just want to complete another quick projection. So giving you a real life sort of scenario rather than just a flat 10% return. And we've got to keep in mind that $1 million in 40 years won't have the same buying power. Now, along the journey as well, which makes it a little bit more difficult, no doubt you'll pay tax along the way. So this impacts investment returns or the net return at the end of the day, and also investment management fees, whether that be product costs or advisor service fees. Now, after accounting for tax, inflation, fees, let's say instead of 10% return, your real net rate of return is approximately 6% each and every year. Now, your actual required contribution in that sense, and let's say we get at 20 years old again, we have 40 years to invest, your required contribution increases to $500 per month over that 40-year period. Break it down, it's a little over $100 per week, so very achievable, and that's a realistic projection, so it is definitely attainable based on those factors that we put through the projection. The key to the strategy is obviously time. Great consistent returns is helpful, and we tend, if we have a longer time period to invest, we tend to get better averages rather than relying on a short-term approach, which isn't perhaps suitable for share investing and being on the growth side of things. But for this to work, yes, we need time, we need to be invested in the right asset sectors, which is growth, and whether that be international shares, Australian shares, or property, they will be the main drivers to make this strategy work. Overall, you will need to receive some good advice, so make sure you're not only in the right asset sectors, but in the right stocks as well. So make sure you utilise the services of a qualified professional and try to avoid doing this on yourself where you can, because there's a lot of benefit by seeking the help of an advisor or another professional. They can give you the reassurance you need over that long period of time that you're on the right path. Thanks for watching the video. I hope it was of value.